Breaking news from Wall Street, the Dow ending the day more than 1,000 points down at the end of trading. That, coupled with some recent data coming in about the jobs numbers, now adding the word recession back into the conversation.
So joining us live right now is Chuck Zada, who is the managing partner, chief investment officer at Armstrong Advisory Group based out of Massachusetts. Chuck, important stuff going on this Monday, so let's get right to it. So this big drop now leading to some investors saying to the Federal Reserve, okay, make some emergency cuts to the interest rates right now. But if that were to happen, what are those implications on the markets in the days ahead?
Yeah, I'm not sure that we're at the point where something like that needs to be done. Typically, emergency rate cuts by the Federal Reserve are a tool that they employ when there's something significantly wrong with the economy, usually in kind of the plumbing of the economy. Companies can't borrow, the cash can't move around the financial system. Those are the times when you typically see something like that. And so, quite honestly, I think that if you were to see the Federal Reserve go in that direction, it might actually exacerbate the issue that we're seeing in markets, because market participants would look around and say, hey, is there something that they know that we don't? Is there a real problem here? Because to this point, yes, we have seen some weak economic data over the last 6 to 8 weeks that has raised the cause of, recession as a potential concern in the upcoming quarters. But I just don't think that a potential recession is something that you do an emergency rate cut for if everything else in the financial system is functioning normally. Remember, markets don't just move in one direction. In fact, days like this, these are good evidence that markets are properly functioning and that they're actually trying to figure out what price different securities should trade at. So something like this is a feature of markets. It's not a bug when you necessarily see markets sliding a little bit because of bad news.
Well, so Chuck, to that end, we saw the reports come out late last week. The jobs numbers much weaker than expected. Unemployment now at multi-year highs. And there's some question about how the stock market is, how the U.S. market overall is slowing or not. So what we're seeing on Friday, what we're seeing today with the Dow, is this a reaction to that news or an overreaction to that news?
I think it's an appropriate reaction. I mean, the S&P 500, which I think is, kind of recognized as the broadest benchmark for the U.S. stock market, it still is not even off 10% from its all-time high. So I do think it's something where the market, is taking this news and digesting it appropriately. It's not something where you've seen markets fall 20, 30, 40%. And those are the kinds of things that typically happen, if you actually were to see a meaningful recession and a bear market. Those are the kinds of things that you would see if that were to develop. So the fact that stocks, depending on the index you look at, have fallen anywhere between, 6 and 15% right now, I think that's a normal reaction. It's not necessarily, comforting to hear that. You still say, gee, I don't like this, but it is something that you would expect to see given the run of weaker news that we've seen in the last couple of weeks.
Chuck, I'm hearing words like normal that you're using, and certainly for somebody who is just on the couch and investing or worried about their 401k, that's good news for them. And otherwise, when we do enter this roller coaster cyclical market ride that we tend to sometimes, we do hear advice from advisors. Sit tight, do not panic. So you seem more like that with things and how they look today.
I think part of it, look, I experience this every day, and so I'm very much used to this. This is the environment that I live in, and I realize that not everyone who is watching is, in the same boat. They might not pay attention to this as closely as I do. So I do want to say, look, it's completely normal to be nervous about days like this, and look, even folks like myself, we have those emotions too as we try to digest what's going on. The important thing is not to make overly emotional decisions, not just in investing. I think that's a good, rule of thumb for life, but you can really hurt yourself financially if you're making emotional investing decisions because of a bad day or week in the market. There's a great stat from Callie Cox, who works at Ritholtz Wealth, and she showed that in the S&P 500's history, 94% of years since it's been around, there's at least a 5% drop that happens somewhere over the course of that year. So this is completely normal what we're seeing. Even a 10% drop happens in 64% of years at some point. So I know it can be scary. I know it can be a little bit nerve-wracking, but this is actually normal for how markets tend to move. It's just not really the most fun going through it, and I totally understand that.
Chuck Zada, Armstrong Advisory Group. We covered a lot of ground, and we really appreciate your time today. Thank you.